Chapter 5. 3 Option Spreads. Every level up. Traders should know. Traders of spread options often find innovative strategies to limit losses. While maximum profit may be capped at a few dollars, even a soaring stock can't unlock limitless gains. It's akin to owning a Ferrari, yet only taking it to the corner store. However, there's a thrill in the journey, even within constraints. Today, we'll explore 3 option strategies that can enhance your expertise and showcase your market savvy. Bear put spread. This elegant strategy allows you to bet on a market decline without overspending on premiums. It's like saying, I expect rain, but I'm perfectly fine with just a drizzle. The bear put spread is like being a gloomy fortune teller who's convinced the market is about to trip over its shoelaces, but also a thrifty shopper who refuses to overpay for bad news. Here's how it works. You begin by purchasing a put option at a greater strike price. This serves as your key profit generator, the intuitive predictor that rewards you when the stock declines. Then, to avoid spending your entire lunch budget on expensive puts, you sell another put at a lower strike price. That second put acts like a coupon for your first trade. It reduces the cost, but it also sets a floor on how much you can win. Bear put spread payoff chart. This bear put spread payoff chart illustrates the profit potential when SnugMug's stock price declines. Embrace the journey, as the purple line symbolizes the dynamic nature of your financial path and the power of informed decisions. Bear put spread. Setup. First, you bought a put option with a strike price of $50 for $3, represented by the blue dashed line. This is your main bet that SnugMug stock will decline. If the stock price drops, this put gains value, much like a jackpot machine pouring out coins. To maintain your expenses at a reasonable level, you sold a put option with a strike price set at $45 for $1, denoted by the red dashed line. This approach generates some income to help reduce the expense of your $50 put. It significantly limits your ultimate profit potential. It's akin to splitting your fries, lower costs, but also fewer rewards. Overall, you spent $3 and received $1, resulting in a net cost of $2 for this strategy. Your maximum loss is $2 if the stock remains above $50, while your maximum profit is capped at $3 if it drops below $45. The break-even point is $48. Bear put spread options. Key numbers. When SnugMug stock trades above $50, your long put is about as helpful as that yogurt lurking in the back of the fridge, expired and forgotten. Nobody wants the right to sell at $50 when the market pays $55, $60, or more. The option expires worthless, and your only loss is the $3 premium you paid upfront, the cost of admission to the trade. If SnugMug's stock price remains above $45, your short put position is as harmless as a cat napping in a sunny windowsill. It will expire worthless without causing you any trouble, and you get to keep the $1 premium you collected up front. A nice little reward for taking on the risk. SnugMug at $45. With the stock price at $45, your long $50 put option, which you purchased for $3, is now worth $5. This is because you can sell the stock at $50 while the market price is only $45. After subtracting the $3 you initially paid for the put option, Your net gain from this trade is $2. On the other hand, your short $45 put option, which you sold for $1, has no value. Since the market price is at the strike price, there's no benefit for the buyer of this option. However, you still keep the $1 premium you received when you sold this option, resulting in a profit of $1 from this leg of the trade. When you combine the results, the $2 gain from the long put plus the $1 gain from the short put gives you a total profit of $3. SnugMug at $48. Welcome to the land of breakeven. At $48, your spread is in the May zone. The long $50 put is worth $2, but since you paid $3 for it, you have a loss of $1 on that leg. The short $45 put expires worthless, which is ideal. You keep the $1 premium you collected. When you add these amounts together, you end up with 0 profit and 0 loss. It's the trading equivalent of running 3 miles to burn off the cookie you stress ate before your run. Sure, you're healthier, but your wallet hasn't moved an inch. SnugMug at $50. At a stock price of $50, the long $50 put is worth nothing because the right to sell at $50 isn't beneficial when the market price is also $50. You've lost the $3 you paid for this option. On the other hand, the short $45 put expires worthless if the stock is above $45, meaning you keep the $1 premium you collected. Combining the results, minus $3 from the long put plus $1 from the short put results in a net loss of minus $2. SnugMug at $80. At this point, SnugMug is throwing a party on Wall Street while you're stuck outside with empty pockets. Both your long put and short put are as worthless as expired coupons. You're out of your maximum $2, and that's that. No matter how high the stock flies, to $80, $100, or Mars, you never lose more than that. Painful? A little. But think of it as losing your coffee budget, not your house keys. Bull put spread. Imagine you're a landlord, optimistic about your neighborhood. You believe property values will stay stable. You write a put option at a higher strike price, collecting a premium upfront, like collecting rent in advance. This means you may have to buy the stock if its value drops. To protect yourself, you also buy a put option at a lower strike price, acting as your financial home insurance. If something goes wrong, like a stock price crash, this coverage protects you from significant losses. You're charging a premium to prevent misbehavior, like asking your cousin for a deposit before lending your car, and also buying insurance because you know your cousin. In simple terms, you earn money if the stock stays stable or rises, while protecting yourself from losses if it falls. Bull put spread, payoff chart. What you're looking at is the bull put spread payoff diagram, which shows how much money you could make or lose when the stock price finally stops its roller coaster and lands at expiration. On the horizontal axis, you have the stock price. Basically, where did SnugMug Inc. end up after all the drama? On the vertical axis, you have profit or loss. Are you buying champagne or ramen noodles this month? Bull put spread setup. When you sell a put option at a higher strike price, like $50 for $3, if the stock stays above $50, you keep the premium and avoid any maintenance hassles. Your maximum profit is the premium you collected. To protect yourself, you buy a long put option at a lower strike price, such as $45 for $1. This acts like landlord insurance, ensuring that if the stock drops below $45, your losses are limited. Without it, you could face significant losses. By combining these strategies, you create a bull put spread. You've secured some upfront income while capping your worst-case losses and positioned yourself to profit if the stock remains steady or rises. Essentially, you're saying you're optimistic but prudent in protecting your investment. Bull put spread. Options. Key numbers. You sold the $50 put for $3 and bought the $45 put for $1, resulting in a net profit of $2 upfront. This $2 is your maximum profit, regardless of how high the stock goes. That premium also shifts your break-even point. Without it, you start losing money if the stock fell below $50. Thanks to the $2 premium, you can let the stock dip to $48 before facing losses. SnugMug at $45. Here's where the profit party tops out. Your short $50 put is now worth $5 because you've promised to buy stock at $50 when it's only worth $45. That's a $5 loss. Your long $45 put, it's worth $0 at exactly $45 because the right to sell at $45 when the stock is also $45 is as exciting as a coupon for one free high five. So at $45, your spread is bleeding $5. But remember, you collected a $2 credit when you opened the trade. Subtract that from the $5 loss, and you're left with negative $3. SnugMug at $48. Start with the long $45 put purchased for $1. When the stock price is at $48, this put is out of the money and expires worthless, resulting in a loss of $1. Next, consider the short $50 put sold for $3. With the stock at $48, this put is now worth $2 because it allows someone to sell at $50 while the market is at $48. Since you collected $3 when you sold it, your profit from this leg is $1 after accounting for the $2 liability. Combining the results, a loss of $1 from the long put and a profit of $1 from the short put gives a net result of $0. At $48, you've broken even, similar to a blind date ending with a polite handshake. SnugMug at $50. At $50, the mood flips entirely, and this is where you shine. The short $50 put expired worthless. No one wants the right to sell stock at $50 when the market price is already $50. Your long $45 put is also useless. The spread referee steps in and declares victory. You get to keep your maximum profit of $2. That's money in your pocket, earned simply by the stock staying steady or climbing higher. It's like renting your house to a friend. They never show up, and you keep the rent money without lifting a finger. The bull put spread is a tug of war between the short put, the troublemaker, and the long put, the safety net. With the spread acting like a strict parent, making sure no one goes too far. The whole strategy shouts, "Yes, I'm optimistic, but I'm not dumb enough to wander around without a helmet." Bear call spread. Imagine you're a landlord who's not impressed with the neighborhood. The houses are fine, the lawns are scruffy, and you're pretty sure property values aren't going up anytime soon. You're betting things will stay the same or maybe even slip downhill a little. You sell a call at a lower strike price. Think of this like collecting rent money up front. You're smiling because cash has landed in your hand before you've had to lift a finger. But because you're not completely reckless, you also buy a call at a higher strike, like taking out an insurance policy in case the neighborhood suddenly turns prime real estate and prices shoot up. That way, if the stock soars, you won't be completely steamrolled. Here, you send a clear message. Hey market, let's keep our excitement in check. You set a ceiling on potential gains, collect a premium, and cleverly limit your losses if the stock decides to soar above your expectations. For all of them, we'll use the fictional but charming SnugMug Inc., the leader in premium, overpriced coffee mugs for those who believe their beverage deserves silk pajamas. Bear Call Spread Setup. You're betting that SnugMug Inc., a company that sells designer coffee mugs with inspirational quotes, is not going to suddenly become the next Apple. You think the stock will just kind of sit there like lukewarm tea? You sell a call option with a $50 strike price. By doing this, you will collect a $4 premium. The break-even point for this call option would be $54, calculated as $50 strike price plus $4 premium. You purchase a call option that has a strike price of $55. For this option, you will pay a premium of $2. The break-even point for this call option is $57, calculated by adding the $55 strike price and the $2 premium. Net credit is $2, calculated as $4 received minus $2 paid. This $2 is not just pocket change. It's your pizza fund, a little treasure that brings you closer to your dreams. Consequently, the break-even point for the bear call spread is $52, which is determined by adding the short strike of $50 to your net credit of $2, which is $52. This serves as a reminder that every small victory contributes to your overall journey toward success. Each gain, no matter how minor, is a step forward in achieving your aspirations. Bear call spread options. Key numbers. The bear call spread is a bet that the stock will sit still or drop. Basically, you're getting paid for assuming the market is too tired to party. SnugMug at $30, boring zone. In this scenario, the stock price is significantly below your strike prices of $50 and $55. Your short call at $50 isn't handy right now, and your long call at $55 is even less valuable. Nobody wants these options at the moment, so both will expire worthless. As a result, you keep the full $2 profit. This means maximum happiness and plenty of pizza money. SnugMug at $51, tiny annoyance zone. The stock price has now risen just above $50. If you have a short call option at $50, that means it is out of the money by $1, which means you owe someone $1. However, since you initially collected $2 from this option, you still have a net profit of $1 after settling that amount. Although your profit has decreased, you can still feel optimistic about the situation. Think of it this way. It's like having half a pizza with no toppings. SnugMug at $52. The Maison Breakeven. This is the break-even point. At this point, the stock is $2 above your short strike of $50, meaning you owe $2 to the buyer of your call option. Fortunately, you had exactly $2 available from the beginning. After paying it back, you're left with neither profit nor loss. In the end, you've put in all this effort for no gain. Like going to the gym for 3 months, only to find that your jeans still fit the same. SnugMug at $53, slippery slope zone. With a stock price at $53, the Shaw $50 call option is worth $3, creating a $3 liability for you, as the buyer can purchase it at $50 and sell it at $53. However, you collected $4 when you sold the option, resulting in a net gain of $1. Your long $55 call option is out of the money and expires worthless, meaning the $2 you paid for it is a complete loss. Overall, you have a $1 gain from the short call minus the $2 loss from the long call, resulting in a net loss of $1. SnugMug at $80. Disaster avoided? Sort of. In this scenario, you face a significant financial loss with the short call option at a strike price of $50. The stock is currently trading at $80, which means the buyer of your call option can purchase shares of SnugMug for $50 and sell them at $80. This results in a gain of $30 for them. This translates to a $30 loss for you. With the stock at $80, your long call gives you the right to buy shares at $55. This means you have a profit of $25 from this call. You receive $2 upfront when you open the trade. Then you incurred a loss of $30 on the short call. However, you gain $25 from the long call. Now, let's do the math. $2 upfront minus $30, short call loss, plus $25, long call gain, equals negative $3 net loss. The bear call spread is similar to being a cranky landlord who bets that your tenants, the stock, won't throw a wild party. If they behave, you get to keep the rent. However, if they get rowdy, you may lose some money. Fortunately, you've taken precautions by purchasing insurance, so your worst-case scenario is limited, ensuring that you're never completely wiped out. Spreads are the grown-up version of options trading. You've traded in the juice box for a latte with risk foam on top. They won't stop the market from misbehaving, but they do make sure you walk away with your dignity, your wallet, and maybe even enough cash for dessert. Most importantly, spreads prove you're no longer the rookie throwing darts at a stock chart. You're the savvy strategist who straps airbags onto every trade and winks knowingly at market chaos.